My name is Roger Ballard, CEO for Nuvision Credit Union, and we're back with another economics webinar with Beacon Economics and Dr. Chris Thornburg. We're thrilled to be here. We're thrilled that you're here. So to learn more about what's going on in the economy and get some expert insights, we started this series back in 2023 and did a number of these, and there seemed to be some strong interest from our members. As we'll reiterate later, we also record these because we know many of our members can't necessarily make the live event. So many more listen to it separately from the recording, we know, based on feedback. So we really do hope this is a great value and provides some great informative information that really helps people, make more educated decisions based on what's going on in the economy. There's certainly been a lot of questions, always are, about the economy. It certainly has a big impact on our lives, on our businesses. And our goal is to empower you with knowledge to help make decisions. Again, no forecast is perfect, but this is a perspective to at least take into consideration as you think about the decisions you're making about your finances and your goals in 2024 and beyond. Again, through the series with Beacon Economics, we're honored to have a top industry expert. For those of you who might not have attended previous webinar, we're really honored to have Dr. Chris Thornburg. He is an outstanding expert, and I'll share more with you in just a moment. Chris can share a little bit about his background briefly. But part of this webinar is certainly to share information, and I think Chris has got a lot of fascinating insights I think you're really going to find interesting. And some things you may, have some different points of view. We actually like that, and we like that in the sense of having some questions back and forth and based on what he covered, or maybe anything that's on your mind that he wasn't able to cover. So as we go through the webinar, we're going to have some opportunities for you to ask your questions, and we look forward to that. And to do that, you'll using the Zoom tool. You'll click on that on the QA icon and just click on type in your questions, and we'll get to as many of those as we can in the time we have. It's the QA box at the bottom of your screen, so you can do that anytime during the session. And then we have, I think, at least tentatively planned 2 opportunities to kind of work through those questions. One certainly at the end, and maybe one somewhere kind of during the middle of the webinar. And then if we don't get to your question today, just depending on how time works out and the volume of questions, we'll make sure we follow up and answer your question by email, assuming we have you provide your information. As I mentioned, again, Dr. Chris Thornburg, he's with Beacon Economics. He's earned national recognition for his expertise in economic forecasting. I'm really thrilled to be back with him. And Dr. Thornburg will provide an update around our national economy, as well as discuss local economic factors of particular interest to our members in California, Alaska, Wyoming, Washington, and Arizona. That's where Nuvision's footprint is, although we have members in most states in the U.S., but that's where we have the most of our members. So with that, my pleasure to welcome Chris. Dr. Thornburg, thanks for being with us tonight.
Oh, thank you, Roger, and a happy new year. It's nice to be back with you. We had 4 of these last year. It's kicking off, of course, our first session this year. Plenty to talk about. Today, of course, it's all about social narratives and economic realities. And let's not, of course, forget that election that's going to be happening in November of this year, which we know is going to be a center of all sorts of things over the course of this particular 12-month period. Myself, just to be clear, I run a company out here in Los Angeles called Beacon Economics. We're an economist sort of consulting company. A lot of people wonder what that is. But what we do is really help people understand what the data means. But we're a little different than a lot of groups, because what we do is we let the data drive the narrative. Most other groups seem to do it the other way around. While we are in LA, we're based across the nation. And yeah, we're kind of well known for our forecast. I was a little hurt when Roger said no forecast is perfect, but I know he wasn't talking about me. With that today, of course, what we need to talk about is what we think is happening in our economy, what is actually happening in our economy. Remember, those 2 things are not the same. And of course, what it all means for the year ahead, particularly in regards to housing and interest rates, and some thoughts about consumer credit today, and some thoughts particularly about the younger generation. As Roger noted, we are going to give you access to these slides. There'll be a QR code at a couple places while we're going through some questions. You'll be able to take your phone and click on that QR code, and you'll be able to get a copy of these slides sent to your inbox in just a day or two. So, all that being said, let's start with the narrative. It's always good to start with the narrative. 2023, the year behind us, was a very interesting year. We came into the year when I first started doing these sessions with Roger. Everybody was talking about the recession that was going to befall our economy at any particular second. We dealt with this most of the particular year. As you might remember, if you've been in one of these talks before, I didn't buy into this too much. And we didn't have one. That's one of the things we could say about 2023 in the rearview mirror. It was a good year, all said and done. But what is more of interest is how things turned towards the end of the year. Because it wasn't just that we avoided a recession. What happened, of course, at the end of the year, inflation started slowing down. You had, of course, all sorts of conversations about multiple rate cuts. You saw interest rates start to go down just a little bit. And next thing you know, financial markets are going through the roof. The stock market near an all-time high level. Bitcoin is up into the $70,000 range. And if you look at the papers a little closer, you will find, of course, it is all supposedly due to the wonderful machinations of the man at the helm of our central bank, otherwise known as the Federal Reserve, of course, Jerome Powell himself. Well, as I've been saying, these are narratives, and these narratives are pretty much wrong. This is not what happened last year. And as far as Jerome Powell goes, I'm sure he's a lovely man. Unfortunately, there is, shall we say, some problems in the policies they've been putting forward. Now, as noted, we never really bought into the recession call. We contributed to the Wall Street Journal survey of forecasters. The overall forecast was at one point in time above 60%. We never had us above 20%, but really about 10%. When you say 10%, that just means business as usual. There's always some chance of a recession. But what's interesting, of course, is the other forecasters have started to back off on their particular numbers. The overall percentage chance of recession in the next 12 months is now below 40%, running about 35%. But they call economists the dismal science for a reason. But, you know, when the article came out in the Wall Street Journal regarding the fact that this is now dropped, this is the exact headline. It won't be a recession. It will just feel like one. Now, honestly, Roger, I don't know about you, but I don't even know what that means. But you know, this is what the headlines are comprised of. Again, last year was not a bad year. It was a very good year. U.S. economy grew by 2.5% in real terms, very much like 2019. And given limitations on labor supply, that's pretty much what we can expect out of our economy, at least in this day and age. A little better numbers towards the end of the year. Q3 and Q4 came in very good. Good numbers for personal spending. Business investment did pretty well. Residential was a bit of a drag, but really good numbers across the board. And yes, we're coming into the end of the first quarter. Again, good numbers. The various estimates we have suggest 2 to 3% growth this particular quarter. So business as usual, the economy just continues to grow. And Americans, they're still having fun. Record foreign travel. Spending in restaurants, 40% above where it was prior to the pandemic. Live Nation had a record year. They were printing money. Every single concert was sold out. Has anybody else noticed about every 74-year-old rocker is trying to slip into their old spandex to get up on stage for one last tour? Well, there's a reason for that. Lots of demand out there for these kind of things. It's kind of like back to the Roaring 20s. Remember 100 years ago, the last Roaring 20s with the Great Gatsby? Booze spending is 20% higher now than it was prior to the pandemic. The good news is we're getting drunk less at home and more drunk in restaurants. I think that's a good thing. You have to be social in terms of our activities. Nevada, busy as all get out. Record gaming revenues in the state of Nevada right now. And by the way, we're going to have great, wonderful wine to continue this expansion with, because for those in California, 2023 was one of the best years for vintages of wine ever. Roger's taking notes. He's going to get a couple cases of that. Airport traffic around the West Coast, slowing down just a little bit as the case may be. But again, it's not so much that people aren't traveling, it's they're going abroad, and foreign travel hasn't yet come back to the region. But overall, households, very little overall household distress. On the right-hand side, these are foreclosures and bankruptcies. Still half of what they were 4 years ago, and of course, a fraction of what they were a decade ago. People really look very good shape. Overall delinquencies of interest rates still very, very low from a couple of years ago, despite all those dismal headlines. Industrial production is up. Factory orders are up. The auto market's finally starting to catch up. After a couple of years where there was absolutely nothing to buy anywhere in the United States, auto sales picking up mainly because there's stuff to buy again. You can see domestic auto inventories are coming back again. On the right-hand side, you can see prices. Your new cars are still expensive. They cost a lot. Used to be, you would argue about how far below sticker you could get. Now you're arguing about how far above sticker you have to pay, but at least things have leveled out, all said and done. Labor markets are still tight. The unemployment rate's below 4%. Job openings rate still elevated. Real weekly earnings are positive. We added 275,000 jobs in February. Good numbers across the board. And regionally, you take a look at some of the numbers. Yes, employment has started to flatten out in a lot of these places, but still pretty good numbers. You can see in the bottom there, for example, Anchorage had a great year, up about 2.8% year over year, after a couple of years of very little growth at all. Great numbers up there. Wyoming, again, decent numbers, 1.5% year over year. Good, solid numbers there. LA, it's interesting. LA has actually shrunk in terms of jobs over the last 4 years, but about 0.5% up. Phoenix, the rock star, 10% growth, 2.8% growth over the course of the last year in terms of jobs. Remember, the big numbers here, the differences in these growth rates, nothing to do with the quality of the economy. All these places still have very, very low unemployment rate. Has everything to do with labor force and labor force growth. You can see the job openings rate is still relatively high in all of Nuvision's territories. It all has to do with labor force. In LA, of course, they've added a loss about 0.5% of their jobs. But then again, the labor force in LA Orange County has shrunk by 3.7%. Waves of retirement, people moving out of the area. It's labor shortages that are driving issue in our economy today. Business investment continues to move forward. 2023, a good year. You saw great spending in manufacturing structures. These are trim plants going up. Transportation equipment's up. Airplanes, putting more planes in the sky right now because people are flying. Software is up. Again, only number here, big negative, residential investment. But even on this front, it's amazing how good of a year it was. We know, yes, existing home sales incredibly low. Why low? Well, mortgage rates, of course, have come up very, very strongly over the last couple of years in response to inflation and Fed policy. But take a look at median home prices. They fell for a couple of months. They hit bottom. They're coming back up again. Home prices right now are at a record high level. So there's little doubt that there are some stresses and strains from the big increase in interest rates in our economy, but none of these things has derailed core demand, and core demand drives the economy. The economy continues to move. And as noted, we got towards the end of the year. Inflation started cooling off. Interest rates started subsiding. We've heard about the Federal Reserve going to cut rates multiple times over the course of this year. Cue, of course, the big turnaround in sentiment. The stock market, which had swooned just a bit, zoomed back to all-time high levels. The PE ratio is 33 or 34 to 1. University of Michigan sentiment still low from a long-run standpoint, but substantially higher than it was a year ago. What you see here, of course, is people are starting to get excited. Even Bitcoin is roaring back. $75,000, I believe it was the last look. This was at when it was 67. Now, again, you start to see these numbers and you realize that while it feels good, there's still something weird going on here. I mean, after all, is there a fundamental value to Bitcoin? Does 75,000 seem unreasonable? To me, yeah. I think the fundamental value of Bitcoin is zero. And if you're wondering why, I might suggest a wonderful biography by an Italian-American gentleman by the name of Charles Ponzi. Lived about 100 years ago in New York City, a wonderful rags to riches to jail sort of story. And it gives you a little hint as to why I don't believe in cryptocurrencies. But listen, I can tell you all I want about how I don't believe in cryptocurrencies. I can't argue with the fact that Bitcoin has a value of $75,000 right now. And this goes back to kind of what I've been saying over the last couple of years, really. But a big part of my presentation boils down to the basic idea that there are social narratives, there are economic realities, and these things don't necessarily fully overlap. For example, the positive value of Bitcoin. That's the power of narrative, right? Bitcoin shouldn't have any value. Why? Because any kid with a master's degree in computer science can make another cryptocurrency. Ergo, none of them can have value, but it does. Why? Well, go look at the websites. Crypto bros have their websites, their parties, their chat rooms. They have their myths, their stories, their highfalutin ideas, if you will. And even if I don't particularly believe that, they do. And in the midst of those stories, in the midst of that belief, real value comes popping out. Now, by the way, it's not just Bitcoin. It's easy to say, point at Gen Z and go, oh, you silly kids, you'll figure it out. Actually, gold is at an all-time high level. Why? Well, people will tell you that gold is an inflation hedge. Well, okay, but inflation's cooled off. So why are you hedging? In any case, Why is gold an inflation hedge? In fact, let me ask you a better question. Why is gold expensive? The real answer is because there's all these central banks that sit on thousands of pounds of this stuff. They just leave it sitting in their basement, doing absolutely nothing. Why? Well, 150 years ago, we used to use that as the basis of our commodity currency. Yeah, no, 150 years ago, we rode horses to work. You see my point? It's a different kind of world. We're not going back to the gold-based currency, but the narrative sticks and the value remains. No matter what the obvious answer is, the price tells you what people are actually thinking, and that's something different than economic realities. The other side of it, by the way, of course, is the unsustainable federal deficit. We have a $1.8 trillion deficit. We're stumbling from deadline to deadline on the debt ceiling. And, look at Medicare, look at Social Security, look at the rising costs of interest. All of this said, this is an unsustainable situation. But I can say, well, that is economic reality is not part of the narrative. I already mentioned, of course, this contentious election we're coming up to. And, we know there are a lot of strong feelings in this country right now. When they walk in that voting booth and they pick that D or the R for all those strong feelings, the reality is they're not picking a D or R on the basis of which party has a better plan to deal with the deficit. It isn't that important to people. That is a problem. Someday it will be. And that day could be very, very ugly. But right now, it's not important to people. And by the way, those D's and R's know that. That's why neither party actually has a plan to deal with the deficit. So this problem continues because we continue to ignore it. At some point in time, economic reality will, of course, kick in. And then last but not least, you can see the third problem. When narratives and reality overlap, say, for example, when we all know Ticketmaster is ripping us off, even there, we have to ask ourselves, what do we do about it? Everybody else seems to get an antitrust lawsuit thrown at them. For some reason, not this organization. However you want to look at it, you see narratives skewing interpretations of news, narratives through economic bubbles, narratives driving bad policy choices. Robert Shiller said we have to pay attention to narratives to understand the economy. Now, Shiller just said this in his recent book, but nothing new has ever been said, right? Everything's been said before. And this is true. My favorite California philosopher, Will Rogers, famously said, it isn't what we don't know that gives us trouble, it's what we know that ain't so. And this, of course, is all having to do with false social narratives. They knew it long before, of course, we started realizing this. Now, the big, of course, narrative that has led us to where we are today all boils down to what happened as a result of the pandemic. The pandemic was a tragic human circumstance, but it wasn't that big of an economic shock to the system. The economy lost about $1.2 trillion of income. In return for that, they spread $6 trillion of stimulus across the economy, funded by $5 trillion of quantitative easing. That is $50,000 for every single American household. Not, of course, a surprise that the economy absolutely took off. But it wasn't just that $50,000. The $50,000 got thrown in the financial markets, asset prices went up. The net result of that is people ended up with $300,000 in brand new household net worth. That, of course, has been driving all that consumer demand. By the way, of that $6 trillion in stimulus, $5 trillion came from the Federal Reserve in the form of quantitative easing. That set off, of course, an enormous increase in the money supply, lots of demand, lots of money. A lot of increase in demand for products, and B, of course, a big increase in prices. And that's exactly what's been happening over the course of the last couple of years. And you can see how people have been enjoying themselves, buying recreational goods, furnishings, and appliances, all that kind of good stuff. Again, having a good time. Now, we don't hear about that. What we hear, the stories about inflation, or how bad it is. And this happens all the time. I'm amazed by how we let this get into our head. For example, this was a survey that came out a couple of years ago where they talk about how 85% of Americans are struggling with inflation. Yet the second bullet, 88% of these people said inflation has impacted their spending at restaurants. The number is 40%. Restaurant spending is up 40%. This isn't what's actually happening, but always remember that surveys don't register reality. It registers narratives. What people are saying here is what they heard in the paper. It becomes a feedback mechanism. Or you have, of course, Gen Z with their stories about how older generations don't know about inflation, never had to fight for a job. But again, it's not just inanity of memes on the internet or these viral videos. The Economist magazine, what's supposed to be this, calm, data forward oriented type of publication, says, could the inflation nightmare soon be over? What are we talking about? Look, inflation is caused by demand. It's not complicated. We know this. And I always recall, of course, the conversation about gasoline. Gasoline prices went up 50% in the beginning of 2022. We heard all sorts of stories about how families had to choose between feeding their children and prescription medications because they couldn't afford gas. Yet for the huge increase, 50% increase in gasoline prices, consumption of gasoline went down by 1.5%. But we don't, what happens, of course, in our world is we ask people about their feelings about things. So we'll interview this gentleman at a gas station. We'll ask him how he feels about filling up his tank. Well, he's annoyed. He's expected to spend $100 and he spent $150. The fact that he's upset about filling up his tank doesn't mean that he's substantially economic harmed. It just means from a benchmarking perspective, he expected to pay less and he's not happy about it. The real question we should always ask somebody is not how do you feel about filling up your tank, but where are you going with your car? And if the answer is you're taking your new boat down to the lake, well, you probably don't care that much about the price of gasoline. And that's what a lot of people have been doing. Now, inflationary pressures have been cooling. Money supply is back in line with the economy. You know, after a couple of years of 6% inflation for consumers, it's down below 3%. And that's filling its way across, of course, the overall supply chain. And demand is shifting. Coming into the end of last year, what you see is a big surge in spending, more on services. People are going to restaurants, they're going to drinking places, more on non-store retailers, less, of course, in terms of gasoline and furniture and building materials. More services, less goods. You can see on the right-hand side how grocery spending has been basically flat while restaurant spending is going up. This is a sign that we've had enough stuff. And what's interesting is there are going to be some stresses and strains as we go into a more service-oriented economy. For example, a lot of people bought boats and a lot of people are realizing maybe I didn't want that boat. So there's going to be kind of a stock of left boats out there, and that's going to create, again, some disruptions. And you also see it a little bit in the warehouse space. Logistics employment is coming down. You see e-commerce as a share of overall retail settling back to pre-pandemic trends, and suddenly you see increases in warehouse vacancy rates. Oh, right. You think, oh, here we go. Now we got another shoe to drop. Well, again, they got a little ahead of themselves. Now we're settling back to normal trends. This is just signs of an economy getting back to something resembling normalcy. But it's not going to go into a downturn. Even now, people still have plenty of money left over. There's still almost $4 trillion cash on hand, 4 times what it was prior to the pandemic in American households' checking deposits. On the left-hand side, people are starting to use credit card debt. They're starting to use their HELOCs again. That's a way of extracting all that wealth. And yeah, I know you've heard a lot about how people have too much credit card debt. Look, any credit card debt is probably too much credit card debt, but we also recognize that it can be helpful. But this idea that things are terrible, well, remember a couple of months ago when you suddenly credit card debt hit $1 trillion and you would have thought the end was nigh. Well, that actually isn't that big of a number. Prior to the Great Recession, credit card debt, people are carrying credit card debt about 8% of disposable income. By the way, they had HELOCs running about 6% of disposable income. Over the next decade, we had the great unleveraging, and you had a big decline in credit card debt and HELOC debt. And, you know, by the beginning of the pandemic, 5.5% and 2%. And of course, when we hit the pandemic, people had lots of cash. Credit card debt fell below 4%. Now it's just about 5% again. I don't see problems here. What I see is people getting back to normal trends, as the case may be. On the right-hand side, household debt servicing. Most consumer debt is in the form of a 30-year fixed rate mortgage. They don't care about rising interest rates because they're protected by that particular financial product. They're just fine. And really, from a long-run standpoint, we haven't had that big of an increase in inflation. Over the last 5 years, Americans see about 3.2% inflation per year. That's, you know, less than half of what it was back in 1979. Interest rates have gone from being very, very low, too low, to something resembling normalcy. This is an economy simply shifting to something that resembles normalcy, and it's going to continue as we move forward. So, Roger, there's a little kind of preview how we got here, how things are going to continue to go. Again, it all boils down to the consumer, the strength of the consumer. They will continue to carry this economy right through 2024, despite all that angry rhetoric we hear in the run-up to this election.
Well, great points, Chris. As always, you covered a lot of great insights and a lot of charts in a brief time. Some great insights about 2023, particularly highlighting the difference again with the narrative. We do have some questions, and again, the QR code, you can use that. Chris mentioned that earlier. If you want to copy the slides, fill out some information. In fact, actually, one of the questions Chris, was on the slides if there's any source notations, because someone wanted to at least take a look at some of the sources for some of this data. Is that something that's
Sure.
available?
It's near the end of the document. We list out some of our sources, but what I would say is if they have a specific question about slide, just you can email Kristen and she'll get you in touch with me. But I'm glad people are interested in data. People always ask me all the time, what do you read? And they go, well, I read lots of stuff, but I also check what I read, right? I don't just take things. I'm constantly looking at the data. Where do you go for data? Best data source out there today is actually the FRED, the Federal Reserve economic data out of the St.
Say,
Louis Reserve.
yeah.
Hundreds of thousands of data points right there, super easy to use. Be curious, go look.
Yeah,
So
we use that
yeah,
at Nuvision often for some of our work. Fred is a great resource and actually pretty easy to use compared to some sites. So
exactly.
another question from a member, Chris, is the current narrative economy a house of cards?
you know, it can be, right? I mean, look at any kind of financial bubble. A financial bubble is a house of cards, exactly what it is. The narrative drives people to have unrealistic expectations of asset price appreciation. And at some point, yeah, that will collapse in on itself. So narratives and the things that narratives create within an economy can be very fragile. They can collapse. I think crypto is very, very fragile. Now, what will cause it to pop? When will it pop? You can't know that. That's by definition what a bubble is. You don't know when it happens, but you know it's fragile. You know something's going to happen. But what isn't fragile is this narrative that somehow or other Americans are suffering, that Americans are up their eyeballs in debt, Americans are seeing declines in their income and declines in standard of living. This is not real. It is narrative, and I got to tell you, that narrative seems remarkably unfragile, which is a real problem for us right now.
Another question, I think you talked about like the basics on inflation, you really being caused by demand. And yeah, and you also touched upon this, and you made, these questions are coming in at different points of your presentation. So you may have covered this, but let me just make sure is one of the members asked, isn't inflation caused by increased money supply? You may have touched upon that, but I just wanted to give you another bite of the apple here.
Sure, it's money and demand. Demand without money doesn't cause inflation. Money without demand doesn't cause inflation.
Yeah,
So
because
you
I
have to have
think you
both.
talked about what is it, the M2? I know they have the M1,
Exactly.
M2
The
money
M2
supply,
increased by
and
40%. In fact, that one graph I had at M2
yeah,
and wealth growth, and we see the two of them grow, cue inflation. That's what sets it off. So it's a 1-2 punch.
1-2 punch. And I think
Yeah.
you also got another question related to, are you concerned with increase in short-term revolving consumer debt? I think you
Yeah, we're going
talked
to
about
talk
that
about
and
that.
really,
We're
and really
going
gave some kind of relative point to some of the past years,
to
that 8% versus
right.
what was it, 5 or 6, somewhere in there?
But I'm going to drop in on that again because it's a
Okay.
whole part. It's a really good question because look, there are rising delinquency rates, particularly for credit card debt, and it needs to be discussed. My point was the level of credit card debt doesn't look extreme, but we are seeing some increase in delinquencies, particularly for younger folks. And that is actually would be a great place for me to jump in on the next set of slides. Should we go ahead and jump back in?
Well, let me see. Let me just check in. So we can get back to some of these. You want to maybe cover the ones we didn't get to on the second break as we wrap up, or do you want?
Yeah,
We've
we
got.
could do that. Like, I mean, look, like the downtown thing, for example, as the case may be, it's not downtowns. It's these office centers, particularly the big commodity ones, like the financial district in San Francisco. It's interesting. San Francisco has been so maligned, and you would think it's just this horrendous disaster of an economy, and it's not. But it is true that there are a few rough spots. You look at, of course, Union Square or in that financial district, and yeah, things are pretty ugly. People aren't going to the office. Those neighborhoods are struggling. But you get outside of those neighborhoods and things are on fire. Same thing in LA. You get out of downtown LA and go to the arts district, both parts of downtown. Arts district is on fire. Down the core part, that Bunker Hills place, not so much. A lot of it all has to do with what drives your downtown. What's interesting is some of the different kinds of downtowns, ones that are more driven by what I'll call by residents, by people, typically smaller ones. And here we're talking about Anchorage, for example, will be a great example of a downtown that's doing very, very well right now. These smaller downtowns, or even downtown Fresno or downtown Bakersfield, believe it or not, are doing pretty well. So it all has to do with, do you have something other than office buildings? Because just office buildings with people not going to office all the time, those neighborhoods are struggling.
And what about the one question maybe before going on, and then there's one Nuvision related question maybe I can just briefly touch on, then we can keep going, Chris. But what about a member asked about velocity of money? Is that more reasonable at this stage?
Well, I look at, okay, so I don't like velocity because that's estimated velocity, which is different than actual velocity. And when I look at velocity, I actually see 1 over the unit money supply. And unit money supply is, well, 1 over velocity. It's basically a quantity of money relative to the size of the economy. And actually, if you ask that same question in this way, it's a great question. And the answer is yes, we seem to be back on trend. And that is exactly why I think inflation's slowing, because again, prices have come up and the money supply has subsided to the point where we're in a better equilibrium. And now with inflationary pressures are backing off. Because we still have the demand, but the money situation is back to normal. That's why inflation's calming down.
Right. And then I'll just touch on one question. I think we're getting to most of these relative to Nuvision, then we can go on, Chris. The question is, how is the current housing situation affecting Nuvision assets and lending situation? So with, we participate in market and market forces like other financial institutions. So in terms of the housing situation, particularly the rate environment, we are doing fewer mortgages than we have done when rates were lower. But we are still doing mortgage loans, and there are still people buying. We're just not doing quite the volume that we had done previously. And we did see, and then maybe another sort of, at least directional data point, if you will, when you look at kind of charge-offs and delinquencies, still very reasonable. We're not, we're a fairly conservative lender, have been forever, but we did see around like the holidays, even coming into like January, we saw some heightened levels. But nothing, particularly, we know we're going to have some different economic cycles. We're actually, I won't, take it, that it's a long-term trend, but we actually saw some improvement though already as we're into this part of the year, like late February into March. We'll see how the month ends up. So still from a kind of overall credit quality standpoint, very strong, and more of the housing situation. It's really affecting more for us the new mortgage volume that we're doing. We're still doing. There are some members who are still buying homes today if they can find them. As Chris, I think, alluded to, we're still seeing a lot of markets with low inventory. So that's still, taking place. And if somebody needs a home, wants a home, they're still buying. Just not
Roger,
as many as there was in low rates.
Housing.
All
We're
right.
going to dive into housing
Is
in a
that
second.
next?
So that's next. Yeah. So
all right, let's go.
Yeah.
Let's go.
Do this. Yeah. So look, again, some of this is repeat for those of you who've been with me before. Again, the problem in the U.S. is a lack of people, and it isn't because people aren't working. Participation rates for 25 to 54-year-olds is at a 30-year high. Problem is we've got a lot less population growth. And less population growth means less labor supply growth. That's our biggest problem. We just don't have labor supply. And this all boils down to the big decline in birth rates we've seen. Of course, we're not having as many kids. People are waiting later in life to have kids. And the whole net result of it is a population pyramid is not population column. And the obvious backstop to this, of course, is more immigration. But we have, of course, a completely broken immigration system in the United States. It's very, very limited. And in fact, most people who are immigrating in the United States nowadays seem to be undocumented. Again, largely because there's no formal system they can get through. Now, are we going to fix our immigration system? No, instead, we're worried about undocumented immigration. And I, for one, agree that who can get across a desert is not a sustainable system for allowing people to move to our country. But we have to acknowledge that you cannot stop people from coming over the border until you fix our normal system. But again, until we get that narrative out there, it's hard to see where this goes. But in the meantime, we're, of course, dealing with labor shortages. Labor shortages, by the way, are good for workers. Now, I already mentioned this. Real earnings for workers are rising. They're not falling. I realize that's a different story. But look at the left-hand side here. Not only are they rising for workers, but they're rising more for lower income earners, workers than higher income workers right now. A little bit of things have come back to normal. But over the last 8 years, course, the bottom 25% of workers have seen a 38% increase in their nominal income. Highest was about 27%. And yes, both those numbers are above inflation. So people are getting ahead, particularly the bottom end. And for our stories of rising inequality, when's the last time you heard this? Turns out global inequality at 150-year low. We're so entranced in our worries inside the United States that we forget that there's enormous growth in middle classes across the planet, China, and so on and so forth. And that's true for young folks. Go back to what I was just saying about how the gains in our workforce are profound. Well, yes, younger workers are getting ahead too. I showed this last time, but I want to. Sometimes people get confused with this. So let me explain what's happening. On the right-hand side here, this is income, real income, so inflation adjusted by cohort. So in 2022, your median 25 to 34-year-old made $46,000 a year. Well, if you are 55 to 64 right now, I will not tell you whether I'm in that category, but I am. Back in 1992, when I was of that age, my generation was making $32,000 a year. So, and it is true that real earnings have been flat over the last 15, 20 years, but they're still substantially higher than they were 30 years ago. But even here, let's keep in mind that, and by the way, you still keep incomes going up across the board. This is data coming into this year. You can see earners on the left-hand side for workers. Again, this is Anchorage. You can see how much those numbers have come up. Wyoming, so on and so forth. Median household incomes. Look at the numbers in Anchorage. Median household income in Anchorage is now above $90,000. How about that number? It's higher than it is in Los Angeles, believe it or not, which threw me for a loop. But again, tells you about, even Roger's looking at that one, tells you a little bit more about the core of what's going on out there. So yes, people are getting ahead. They are doing well. But this brings us into, of course, the conversation about, this. And that has to do with the rising delinquency rates. You are seeing an auto debt and credit card debt. So I told you, credit card debt's low, incomes are up, debt burdens are low. You're starting to see stresses in this particular category. And when you dig in a little bit, what do you see? It's younger folks. On the right-hand side and the left-hand side, you see the big increases in delinquencies are actually for 18 to 29-year-olds. These seem to be the folks who are getting ahead of themselves. So you might say, well, that's because these young kids have all the problem with student loan debt. They have all the problem with that kind of stuff. Well, yes, maybe no. What's interesting is when you take a look what's happened over the last few years, it's actually been a fairly progressive asset bubble. For example, let's just take a look at net worth by age of person. This is from 2013 to 2022. And it turns out the biggest increases in net worth is for people less than 35 and for 35 to 44. So younger folks are actually getting ahead, not falling behind, as the case may be, at least relative to where they were 9 years ago. So if anything, we should be seeing less delinquencies, not more delinquencies for this particular age category. Or even on the right-hand side, you can see lower income households, yet again, have seen pretty good increases in their net worth. So everybody really is better off. So why are people having problems? Well, I think it goes back to the narrative. People are starting to get ahead of themselves. And a lot of this goes back to social media and how social media is impacting how we think about ourselves in the context of society. And in particular, we know the toxic nature of this constant just flashing of wealth and money on social media at all time. Everybody has to be in an Instagram moment all the time, they feel. And yeah, you see these generations really constantly being stressed, feeling anxious, feeling like they're not keeping up. And, there's two ways of going about doing it. One, don't do anything and they feel terrible about themselves. And the other group are getting ahead of themselves and they're having credit card and debt problems. And the real answer is everybody needs to slow down. Look, you're not falling behind. Your life is great. Your life expectancies are up. Infant mortality is down. Crime rates are down. Poverty rates are down. You have cell phones. When Roger and I were kids, this was a cell phone. Okay. It's amazing differences, the case may be. Cars today versus cars when Roger and I were a kid. They used to blow up on command. It was quite neat. Televisions back in the day versus the television today in ungodly amounts of context. Even dieting, dieting used to be hard. Now you take a shot. It's very easy, right? Just take a pill, no problem. But with that being said, there's a lot of mental health problems in this nation. You see it. You see it with mental health diagnoses. Suicide rates are up. Self-harm rates are up. We have an incredibly stressed generation. One of my favorite authors, by the way, Jonathan Haidt, wrote a wonderful book called The Coddling of the American Mind, where he dove into this. And his recent one is called The Anxious Generation. And it does go into the idea that, look, we know younger generations are really struggling, but it's not the economy that's causing them to struggle. It's our narratives and our broken narratives and how we're not teaching our kids about how life really works and what really constitutes our happiness. And you see some of this stress, yes, in some of these financial numbers. But again, the economy itself, this isn't it. And even housing. You know, it's interesting. Every time you turn around, you hear nothing about how housing is so expensive and no one could ever afford it. And oh my God, it's tragic. But take a step back, get away, and take a look at actual affordability. Now, I calculate affordability very simple. It's the simplest way. Take a value of a house, figure out the 100% loan to value mortgage rate for that year. So you're counting the interest rate, throw in a little bit for upkeep and taxes, and then you compare that to median household income. And honestly, what's interesting here is yes, housing is expensive now, not as expensive as it was back in 1988. I'm sorry, 1978 or even 1981, but it is more expensive because interest rates have come up. But this is a short run phenomenon. We went through a decade of some of the cheapest housing we've ever seen. Now, again, why? Well, because we ran around telling everybody don't buy a house, they're expensive. They weren't expensive. They've been incredibly cheap. But now they're not because interest rates are up. And that's sort of the key. This was a short-term phenomenon because we told everybody not to buy a house. Nobody bought a house. By the way, that's why housing was so cheap. Think of that, right? But then all of a sudden, we hit in the pandemic, interest rates are down, people are sitting on piles of cash, and all the people who've been waiting for home prices to drop, listening to those silly headlines, went out, started looking for a place to buy, and they realized there's nothing to buy. Cue, of course, an absolute panic. Everybody's throwing money. Prices went up 50% in 2 years. 50%, we've never seen anything like it. Then, of course, the Fed panics, they hit the brake, mortgage rates shot up in the mid sevens, the party's over. But the party's over, but it's not collapsing. There's no Great Recession type meltdown in the bubble here because the fundamentals of housing are fantastic. There's tons of equity. I already showed you people aren't sitting on a lot of debt costs because they all refinance at 2.5%, 3%. The real problem is there's nothing to buy. And there's nothing to buy in part because people aren't selling because they're locked down on that 30-year fixed rate mortgage. It's also the fact that we haven't built enough housing for the last 10 years, again, because of the narrative. The miserable of a narrative caused people to not buy housing during a period of time when housing couldn't have been cheaper because of those incredibly low interest rates. And builders didn't build because we were told things were terrible in the housing market. And this is the consequence. Now, of course, we're on the other end of it. There's nothing to buy. And yes, in the midst of that, housing is suddenly doing well. To Roger's point, people are buying homes. They're buying a lot of new homes. New home sales right now are running 450,000 a year. That's substantially better than it was 4 or 5 years ago. Builders, their single family housing starts towards the end of last year, got well above 1 million. That's better than any point in time from 2010 to 2019. So builders out there, if you build a new place in the right spot or part of town, you're going to sell it. You're going to do well with it. There is activity out there. And, listen, I tell people, is it a good time to buy or a bad time to buy? I wouldn't buy right now. Look, over time, nominal prices will be flat. Interest rates will settle down a bit. Incomes will come up. And it'll get back into line with normal levels of affordability. Be that as it may, sometimes you got to buy. You got a family. You're about to have a family. What I tell everybody is take it slow. Don't get in over your head. Buy something you can afford. Don't think this is your forever house. Buy a condo. Just get in, take it slow, and eventually you'll work your way up over time. I think that people stress out trying to do everything at once. Everything's got to be a little bit iterative. Just be smart about things. And, when you look at prices across some of these markets that Nuvision is, whether it's Anchorage prices are still substantially higher and they haven't risen quite as much. Phoenix is off the charts. They're insanely expensive right now, but they're not coming down. Same thing, of course, with LA and Wyoming, as the case may be. Getting nothing to buy. Markets are tight. Vacancy rates in apartments are tight. People are waiting to get in. It's going to take some time for people to get in. What this all means is take your time, work your way in slowly. But again, it's not affordability that's the problem out there. It's just a lack of supply. Build it, plenty of things. Now, if you want to talk about housing, you got to talk about interest rates. You got to talk about interest rates. We got to talk about the Federal Reserve. And the Federal Reserve itself has been really out there. We've heard all sorts of reasons why we have inflation, except for the obvious one, that they expanded the money supply by 40%. We heard it was supply chains, the deficit, corporate greed, commodity prices. It wasn't. It's because they expanded the money supply by 40%. One of the oddest ones is inflation expectations, which is exactly what Jerome Powell believes. He believes inflation is driven by expectations. And that is one of the reasons why he feels like he has to stop inflation, because if you let it go, it'll just keep going on its own. Now, Milton Friedman said it best: inflation is always and everywhere a monetary phenomenon. And this is such an obvious quote, and I always wonder why he said it. Well, again, he had the wisdom of years, and he's seen these periods, and he heard what people said. It's amazing to me, with all our collective knowledge of monetary economics, here we are not willing to acknowledge that we have inflation because they expanded the money supply. We're still pretending otherwise. It's interesting to see the power of the narrative, even in these kind of circumstances. Now, what does that mean for Fed policy? Well, the Fed's thought process has been inflation was caused by an exogenous shock. But once it started, it keeps going because of expectations. They also believe it's been terrible for American households, which I just showed you lots of data. People are doing fine. But the last thing what we end up at is that the Fed must fight inflation, even if it hurts the economy. And he's out there. I believe we got to stop, and I got to stop inflation, right? No matter what. Now, you've heard about multiple rate cuts this year. And honestly, I have looked through these Fed releases. They haven't talked about Fed interest rate cuts. It's they get this analysis by looking at some data that's published as a secondary output of the Federal. I won't even get into it, but there's one little forecast they put out which suggests that the Federal Reserve thinks the federal funds rate will be lower in 2025 than 2024. That's all. It doesn't tell us why they think that, but why they think it is because they think the economy is going to get weak, which it isn't. The whole point is they've never said they're going to cut. And they came out in December, it's not going to cut. January, not going to cut. Press seems to say cut. They go on 60 Minutes, which just ran around doing nothing but saying, we're not going to cut. You keep hearing cut. They're not going to cut. And by the way, here's the key. Even if they started cutting the federal funds rate, it doesn't matter. It doesn't matter. The federal funds rate controls the short end of the curve. It controls short-run interest rates. When people think about housing, they think about the 30-year fixed rate mortgage, and that is driven off the 10-year bond. And the 10-year bond interest rates are not going to be coming down for two reasons. A, there's less supply of capital, and B, there's more demand for capital. When there's less supply and B, more demand, that means a higher price, that means higher interest rates, regardless of what the federal funds rate does. Remember, the Federal Reserve is not just keeping the federal funds rate high, they're also engaged in quantitative tightening, $90 billion a month, taking money out of the money supply through the opposite of quantitative easing. They went in by $5 trillion. They came back out by $3.5 trillion. And this is why, by the way, bank debt is hard to get right now. Banks are doing fine. For all the stories about debt going bad, bank debt is actually remarkably clean. It's seen a little bit of stress in it, but for the most part, looking good. The issue with banks, of course, has to do with the fact that quantitative tightening is reducing bank deposits. Bank deposits in the United States are down by 6% year over year. And that is what's causing, of course, banks to really have to struggle, if you will, to find capital. And if you take a look at overall lending patterns, lending has been flat over the course of the last year, growing just a little bit right now. It's harder and harder to get loans for C&I loans and stuff like this. And it all boils down to the fact that, again, the Federal Reserve has been engaging in this quantitative tightening. Well, that is what's keeping interest rates hard. That is what's keeping debt hard to get in this particular market right now. It's that particular action, not the federal funds rate. It isn't all that important. Now, they should be backing off. Things are fine. They don't need to push this any farther, but they're not because, again, of those odd narratives they're following. And it really boils down to really some of my frustrations with the Fed and the Fed policy. Look, the Fed has three main mandates. Their mandates are, of course, to regulate the banking system, regulate price stability, and try to keep the economy and humming along in a good, healthy state. Well, these three things don't necessarily align. Sometimes if you do more of one, you create problems for the other. For example, if you stimulate the economy, that can also have inflationary effects. Ergo, you make small steps, you take small changes, but they didn't. They wildly overreacted to the pandemic and as a result caused inflation. And now, of course, they're wildly overreacting to inflation, and they're causing problems in the credit availability system. The Federal Reserve called Silicon Valley Bank, who failed this about a year ago, a textbook case of mismanagement. Well, I think the Federal Reserve needs to look in their particular mirror. And remember that even as the Federal Reserve has their foot on the brake, still on the brake, quantitative tightening, the federal government still has a $1.8 trillion deficit, and the cost of funding all that debt continues to rise at a rapid pace. A year ago, it was $500 million, and 2 years from now, it'll be $1.5 trillion they're going to spend just on carrying the interest. That in turn will also keep, of course, interest rates high. So ultimately, even if you see the federal funds rate start to come down, you're just going to unwind the yield curve, and that will not have a lot of impact in the 10-year Treasury. And again, with the wound up yield curve, the 30-year fixed rate is going to continue to have high spreads over the 10-year Treasury. What this all means is interest rates are going to be higher longer. We all need to acknowledge this and make our plans accordingly. And for again, those of you thinking about housing, no, there's not going to be price declines or lower interest rates immediately in your future. Make your choices with that in mind, because that's going to dictate how this thing shakes out. So let's kind of wrap it up real quick here. Again, we're coming into a contentious election, and it's interesting, the two views that these two parties, these two candidates are bringing forward. One, of course, says we're descending into a quote unquote descending into a cesspool of ruin, and in many ways we're living in hell. Now, we understand Donald Trump can be, he likes to, shall we say, be a little hyperbolic. But we can go to President Biden, and his is America's coming back. Our future is brighter. The greatest comeback story ever told, right? Well, who's right? The answer is neither one of them are. The economy's not in trouble. The economy's doing fine. Excess demand causes inflation, not recessions. And that's what we're coming out of, a period of time of excess demand. And yes, higher interest rates are hurting certain industries. Banking will tell you all about it. Real estate will tell you all about it. High interest rates hurt. But we have a lot of liquidity in our economy, relatively low private debt levels, and that means it hasn't hurt all that much. Consumer demand will remain strong because of all that wealth in the system, and that's going to keep the U.S. economy trucking forward as well. And by the way, let's talk a little bit about banking. You know who's struggling right now? It's the business banks, because they rely, of course, on business deposits. The consumer banks, whether in particular the credit unions, they're our banks. They don't call themselves that, but they are banks. The credit unions, of course, are doing very well as well. Credit unions are becoming an incredibly important part of our credit system right now. And again, it's for members out there. Again, this is a little sales pitch here, but it's good. It's good to be with credit unions right now. They're there with you, and they're going to be able to help you out even as you navigate this higher interest rate regime. Now, there are obviously these big medium-term risks. The Federal Reserve has released the Kraken, so to speak, and the two Krakens are this out-of-control deficit, which nobody in DC seems remotely capable of dealing with. And yes, asset prices look bubbly high. Now, it's not everything, right? Even if you look at the stock market, the overall PE ratios are up, but I have a buddy of mine the other day who does trading, and he says, yeah, but if you do a little slice, well, you'll find there's a big hunk of the market's priced right, and then there's a smaller hunk of the market that is insane. And of course, yes, a lot of that has to do with tech and AI and all the other kind of good stuff out there. But nevertheless, you do smell signs of bubble out there. How does this shake out? And if it does shake out, how does that impact consumer demand? All these things remain to be seen. It's not short run. We're going to have a couple good years of growth in front of us. I'm not worried about that, but there are these medium-term risks out there. But for me, the greatest risk of all has nothing to do with the economy. It's the risk of coming from the political place our economy is in right now, our world is in right now. It's an incredibly ugly, contentious election. Both sides are palpably angry because the narrative has been running amok and pulling politics in its wake. Both sides are in crisis mode. Both sides think the other side's taken over the world and destroying it. And the answer is things are pretty good. We have some issues that we can address, but to address these issues, we need to walk away from these over-the-top narratives, focus a little bit more on our realities. And I think if we can get the narrative pushed in that particular direction, we're all going to be a lot better off as a nation as we continue to move forward. Our forecast for this year, very similar to our forecast last year, a little bit of a slowdown in growth overall, but the interest rates roughly where they are right now. And of course, housing market, again, roughly where it is. So with that, Roger, I think that kind of wraps up where I am. I know folks are going to have some more questions for me. I welcome it. But again, I think my view is relatively positive on things. And even when it comes, of course, to some of these issues we're seeing with younger people, I acknowledge there's a lot of stresses and strains out there, and we have to focus on those. What we need to do is step back from blaming the economy for this. There's something else going on in our national psyche. We all need a real good therapy session, somehow or other, natural therapy. I elect Roger to be our therapist.
Oh, no, you don't, Chris. First, I need it. I need it to be able to give it to you with any kind of competency. Great points, Chris. It's, as are quite direct about it, it's so different. Some of your points from like so much of the mainstream, most common, kind of media that you hear and read. So it's very interesting, for me, and I'm sure many of our members to hear your points of view. I'm going back. Some of these came in even before we got through. We may get some additional questions, but let me just these aren't necessarily in any particular order. But let's see. One is, and maybe I can just quickly address it. I'm not an expert on it, but it kind of, I think, it relates to maybe Federal Reserve we talked a little bit about, but not necessarily the economy. Asking about Fed Now, what it is. It's basically the Fed Now, the Federal Reserve has a new service. It's, basically doing instant payment, instant movement of money. And it's a relatively new, I say relatively new, service, but they're allowing, institutions and individuals can send money instantly. We have something reminds me of it relative to Zelle as a service we offer our members for free that allows you to instantly, send money. But FedNow is something we're looking at. We are not participating right now. We as a Nuvision, because that was also part of the question. I do think in time, and what we're seeing just in a technology standpoint, and is that things are moving faster. There's less you need to write a check and have all this float. That's not the case. The world we're living in, more. The float is going away for the most part, and so this is, I think, just an evolution and another platform that's just going to allow the ease of moving money, and I think it'll probably gain more adoption, but we're not doing it right now, kind of moving slower and to learn more about it. But I wouldn't be surprised if we participate in the future. A couple comments, and I don't know, Chris, I know we don't get political because we know our members have a lot of variety of political, and it's
Sure.
not meant to be political,
Yeah.
but some around the topic of immigration.
Right.
Somebody says, don't we have a legal immigration process? I'm not an expert. I think you referenced this indirectly, at least. We do,
it's
but it's slow.
underfunded, and the court cases are a year, and it's incredibly
Yeah.
slow and everything else. And we know other countries are doing it more efficiently. It needs to be fixed. And even a lot of systems, for example, we got rid of the old farm worker system, and we never really replaced it with a reasonably good new one. So, but be that as it may, like, let's go to the second question with AI and everything else. Do we need immigrants? Hey, my argument is yes, we do need immigrants. We have a lot of seniors. We have a lot of people living to older ages. And if we're expecting to be able to continue to fund Social Security and Medicare and Medicaid, I think we need to expand our tax base, which means expand our employment base. AI, listen, there's a lot of promise to AI, but then there was a lot of promise about the new economy and a lot of promise about the value of subprime. See where I'm going here? The hype of these things can get ahead of themselves. AI is yet to really prove its worth, shall we say, changing things. In fact, in general, the tech revolution and its impact on productivity slowed about a decade ago. This may actually re-engage tech back into helping us be more productive, but it's a slower process than anybody thinks. My personal feeling is you probably do need more immigrants. If we choose not to have more immigrants, then be prepared. We have to make some real changes in those programs to make them sustainable from a long run standpoint. As economists, you say, like, we don't need to have a political opinion. We can still have an honest conversation about what the costs and benefits are. Even here in California, there are many people say, well, don't build, why don't we grow? We don't build housing. Well, I don't want more housing. Okay. That's a perfectly reasonable desire. And as a democracy, we have a vote and we decide, do we want more housing or not? Here's the key. If you don't want more housing, be prepared to accept the consequences of not having more housing, including the fact that your kids will probably not be able to live in your neighborhood. So to me, lay out the costs and benefits, make the democratic choice. That's how you go about doing it. But in our world, we can't even have an honest conversation about cost of benefits. That's where I start having problems on things.
Well, I think that's a great point. As someone who has kids and some of them, interested in a home, it's tough in some of these, even the markets we operate in. It's tough for them to get even an
Yeah,
entry level house. And what we know is that there needs to be different price points, for people to get into
yeah,
home ownership. And if there aren't, that's a challenge. That's a problem.
it's a big challenge. Absolutely.
Yeah, someone mentioned just if what do you make? I think you have an opinion, and I think I do myself, of a large number of houses owned by empty nesters who live by themselves in homes that have 3 bedrooms, as an example. My
Yeah.
guess is it's either paid for or it's with a low rate, and maybe they like the space, but I don't know. You have any view on that,
Well,
Chris?
look. There's a huge problem with liquidity, and that's true in California because of our Prop 13. It's true nationally now because of the fact that you can't carry your fixed rate mortgage with you when you go from property to property. So what ends up happening is, yes, not only do we have a shortage of overall shortage of housing, but we have a misallocation of housing to how people need it, right? And if we would think about that, if we realize that housing liquidity is just as important as housing supply, then maybe we could lean in from a regulatory standpoint and figure out how you, for example, start making mortgages. And Roger, you're the banker. Work with me here. If you buy someone's house, you can buy into the mortgage. What is that process called?
If you
Um,
buy it, say it again.
if you buy somebody's house, you can assume their mortgage or
Oh,
something like that,
yes, yeah.
like an
If you
assumable
assume some,
mortgages and
yes,
stuff like
yeah,
that.
assuming that's
That
allowed. Yes, yes,
yeah,
yes.
if you could assume the mortgage, that would make the market much more liquid right now. And I think they do need to lean in on liquidity. That question hasn't been asked a lot. But yeah, your point's very well made.
Yeah, well, and it's a member's point. So another one, I'm gonna hold off a couple questions about slides and things. I'll get back to those. I think, let's see, tuned in. Okay, that might also, I know someone else has Fed now has a lot of concerns. Will those be weighted in the Q&A like this? Well, the only thing I'd say, and I'll just repeat, at least for New Vision, and maybe we do some either other webinars like what we call New Vision Insights. We might be able to have time. This is more about economics, but I would say, just to reiterate in case I wasn't clear, FedNow right now, New Vision isn't participating. That's where we're actually doing research, because we do know that there's kind of pros and cons. We tend to, stay abreast, but kind of do a crawl, walk, run approach on something new, just to kind of take it slow to make sure we learn about it. But we certainly do want to make sure we stay relevant in the services that we offer. So we're not yet participating in FedNow, but we will monitor and assess risks and provide further updates there. Let me go back to a couple maybe logistic questions, because I know we're wrapping up. I'm watching the time too, Chris. So someone asked, does the first QR code get both sets of slides? Yes,
You get
either
all the
one.
slides.
Yeah,
Yeah, same
either
QR
one, you
code.
get them
Yeah,
all.
yeah.
And then someone else asked, how will we get access to the recording of today's talk and the slides accompany it? Well, I think so the whole recording, you get the video, I think, just like this, and it'll be sent out. I think we hope to tomorrow, but let's just say by end of week. Just in case you run into any technical, because I think the team has to do a little edits to, not substantial, just to take out some of the early, like tech check stuff or something. So I think we'll have it available, let me say by Friday, if not sooner. So that will be available to you, and I think we'll be sending out an email on that for those who've registered. Let's see, I'm trying to think. And someone else says anything about the recording, so hopefully I've answered that. And let me just see if there's anything else here right now. Okay, oh yeah, we got the, okay, and this is the same, someone was asking, can we have the QR code up? So you must have saw that. That's good. Chris, someone said, with the reduction in the availability of Bitcoins coming up here, the value is going skyrocket. I understand that you will see this as a paper dragon. Would it be worth adding to a portfolio?
No.
Okay.
Like, there's no there there. If you buy a share of a company, you get a share of the profit. You buy a apartment building, you get rent. If you buy a business, you get profit. If you buy Bitcoin, you get nothing. There is no dividend. There is no there. Ergo, you shouldn't be investing in it. That's just my personal opinion. But again,
Yeah. And some
People
people,
can
and
make
I
their own
do know,
choice.
and you probably know it, Chris, there's some out
Yeah.
there who are saying, I've heard say, like, say, hey, 1 to 3% of your investment portfolio, if you have the risk tolerance for it, okay, but don't bet much. Even the ones that, at least that I've heard, if you're going to
Right.
do anything, do a very little. And I tend to agree with Chris and some others who, but I also know people who are big fans. I think Chris alluded to that. There's segments of investors who they are very passionate about Bitcoin and related crypto. So you have to make the decision that's right for you. So I think I'm just checking through, see if we missed any others. I think we've gotten to them all, Chris. And again, just want to thank our members for joining us. I know in fact, somebody mentioned they have the time a little off or time zone. That's why we record this. In fact, we know from the data that we even have more members who are, listen to it after the fact. So that's why we record it. We'll make it available. Really appreciate everyone joining us. We hope this is valuable, gave you at least some, shall we say, some food for thought from a great expert in Dr. Chris Thornburg. Chris, thanks so much for joining us. It
My
was a great
my pleasure to be
opportunity.
here.
Yeah,
As
thank
always,
you. It's
Roger.
always an honor, and thank
Yep.
you for sharing some great points and great information with us. We appreciate it so very much. Thank you.
All right. Thank you. See you next time.
Bye-bye. Have a good evening, all.